Hello, my friends. Brett Pattison coming at you from the financial capital of the West, Salt Lake City, also known as the Land Bountiful. Spencer coming at us from Logan, Utah. Joined with the chairman as well, Brian. How we doing, gents?
Doing good.
What's up, brother?
The market.
Market is up.
Market had a great day today, which, in fact, let's look at right now. The S&P 500 on the year. Oh, this is actually kind of surprising. On the year, the S&P 500 is up 8.99%. The NASDAQ, 8.77%. So the S&P 500 is outperforming the NASDAQ slightly on the year. Over the last 1 year, returns are not coming up on my computer.
NASDAQ's going to be a little better over the last 12 months, for sure.
Yeah, over the last 1 year. NASDAQ's up 40%, S&P up 26.5%. So that's where we find ourselves. So first off, fellas, there's a couple things I want to talk about today. Very important. I'm going to be very serious today. But I want to do it under the idea of short-term thinking versus long-term thinking. Okay? Because what do you think, if you talk to 10 people, how many do you think are short-term thinkers focused on the next 12 months or long-term thinkers focused on the next, 5 years? Percentage-wise, what do you think?
You're talking investment or just people in general?
People in general. In general.
Well, I think 12 months is a long term. I think most people are thinking day to day, week to week.
Okay, so very short term. All right.
Yeah.
Brian, like when you say most people, 9 out of 10, 8 out of 10, 10 out of 10?
75%.
75%.
Seven and a half.
7.5 of those people. One of them got chopped in half.
Yep.
Brian?
Live in the moment.
Short-term thinking.
I mean, yeah. Everything else is, just, I think most people are thinking in the moment. Well, I do think people are worried about the future. Of course, and I think their worries are about the future are heavily influenced by the recent past. I think that's typical.
Yep, recency bias.
Uh-huh.
Yep.
I met with someone this morning. They obviously said, we wish we would have been doing the financial plan 20 years ago. We've just been winging it up till this point. And what they mean by winging it is they've been focused day to day, their kids, yada, yada, this, that, everything else. They're very short-term focus. And sometimes that works out in their situation. Winging it has gotten them to an okay place. But yeah, I would say a large majority of people just short term.
And if you think about how our ancestors lived, shelter, food, making sure you didn't die, right? Security, what do you call that? Protection, protecting the family. Right?
Survival. Call that survival.
That's the word I'm looking for, survival. That's how our ancestors lived. That's how, that's how kind of we're hardwired, so that makes sense. But the topics that we'll bring up today, we will put in short term, which is what most people think of, and then long term. And we'll talk about what somebody should be focused on. So the first one that I want to bring up today is something that occurred yesterday and a little bit today, but that was the inflation numbers came out. And let me put some context to this. Inflation went from June of 2022 at 9.06%, which was insane, all the way down to 2.97% in July or June of last year. And then it creeped up and it's kind of been going sideways. Last month was 3.15%. Now it's at 3.48%. So inflation is kind of going sideways and it's not coming down. It's 3.48%. And inflation dictates what the Fed is going to do with interest rates, right? So if that inflation doesn't come down, the Fed won't cut interest rates. Okay, is basically what we're hearing in the media. So inflation and interest rates in the world of investing. Short term means what? Either of you. To the market.
Brian, you go first.
If so, let me phrase it this way.
I'll say this, Brett.
easier.
Short-term interest rates is the cost of money. So that's what we're talking about. It's the cost of money. So from an investment standpoint, it is the cost of money to invest, whether you are an individual investor and you're wanting to borrow to invest, or you are a company and you're wanting to invest further in your company, or whatever it is the cost of money to invest. And that's what like when we're talking 3 months, 1 month, 6 months, whatever, short-term interest rates is the cost of money.
Yeah. Okay.
And I'll just add that, it's a real cost for a business. You think about borrowing money at, say, a couple of years ago, there high quality companies were able to borrow at probably 3%. Now those costs are 5%, maybe 5 or 6%. There's a real cost to that money, to the bottom line. So I think there is an impact on the short term, but it doesn't make investing necessarily a bad thing. It's
So now wait, hold on one second. Yesterday, inflation came out and the market, I'm not going to say tanked, because tanked is that's different for everybody. But the market was down 1.5% yesterday. Like, it didn't like the news. So short term, higher inflation rate, higher interest rates. Shouldn't that mean a down market?
Well, yeah, for a day. Here, hold on. I do want to get on a soapbox. We're going to go off on a tangent for a second.
I love tangents.
Let's go
Spencer
tangent for a
are my
second.
favorite.
You talked about inflation being at 9%, then going down to 2%, then being at 3%. Do you notice that inflation has never gone negative? Meaning the prices today are still higher than they were a year ago. Now they're 3% higher. And then the year before that, they were 9% higher. So we always talk from a planning perspective. The greatest enemy to anyone's wealth is inflation. And okay, this is where I'm going to temper everything. The government has done such a ridiculously poor job of keeping inflation under control and not understanding the source of that inflation. But when you look, Wall Street Journal had an incredible article on what $100 worth of groceries gets you today versus 5 years ago. Was it 5 years ago, 10 years ago? I can't remember exactly. But it is absolutely ridiculous what we're talking about with inflation, how much more it's gone up. It hasn't gone up 3%. Yeah, but if you look from 2020 until today, inflation is huge, more than 25%. I can't remember if we're 30% higher. It might be 30% higher. Go ahead, Brian.
In some cases, I read that same article. It's 25 to 30% higher prices.
25 to 30% higher. You want to talk about destruction of an economy? That's my tangent. Okay, I'm going to get off the tangent because I know you're going short term, but long term, these prices are here to stay. And if you want to look at long term, that inflation has completely eroded people who are living on fixed income. Now, they're also getting something from their savings, but okay, time out. I'm going off on a tangent, but
no,
that inflation, people hear 3% and they're like, oh, that's not that bad. Well, it's 3% on top of 25% already. It's ridiculous.
So it's destroying purchasing power. If you're invested in, what did you say?
If you are on a fixed income.
If you're on a fixed income and invested in.
Yeah.
fixed income.
or fixed income or cash equivalents, you've been destroyed. Your purchasing power has just been wiped out.
If you are not investing in something that overcomes that inflation, then
Yep.
you're in a world of hurt.
My tangent led to something good.
Yes, it did. So you've got to be invested in equities to overcome the purchasing power risk of inflation, right?
Yes.
I mean, you have to be invested in assets that can appreciate during an inflationary time.
Oh,
That can be that can be real estate, that can be a business, but owning fixed assets or short-term cash or having your money buried in
annuities.
your backyard, it's just your purchasing power will be destroyed by inflation.
Okay, so short-term thinking inflation. Here's why I think it matters. Did I just say that? I said it matters.
Yeah.
I think it matters to the fear mongers, especially in an election year. That's why I think it matters. Other than that, long-term thinking, if you're invested appropriately, which we have, our clients invested appropriately, I don't think it matters at all.
Well,
Am I wrong, or where do you guys stand?
I think it's nuanced. I don't think it's that simple. I think you're right in terms of if you're with the qualifier, if you're invested appropriately, you're less impacted by inflation. But a lot of people who, like Spencer said, are on fixed incomes, or most of their investments are in, say, cash equivalent type. I mean, yeah, it's definitely affected them.
I would say,
go ahead.
Sorry, I would say, Brett, it matters from the standpoint of the cost of capital to the companies that you invest in. Like, how does it matter to us? I mean, you go back to late 70s, early 80s, and we've done podcasts on this before. During inflationary times, what does Buffett look for? Buffett looks for companies that have pricing power and that are run by really good managers, and that goes with our competitive advantages and that kind of stuff. But from an investing standpoint, you want to be invested in companies that can continue to do okay in an inflationary environment. And so those are specific types of companies. So I think it does matter, those short-term rates, not necessarily are you invested, are you not invested, but just being selective, like you said, invested appropriately and being in the right types of businesses to be able to handle the shorter term inflation, because it affects companies too. I mean, when cocoa powder goes up 50%, it affects a chocolate company, so to speak. I mean, there's those types of things that you have to take into account.
Creates opportunities. In 1990 through 2000, okay, interest rates were 5% and 6%. Okay. Drastically, well, not drastically, but a lot higher than they are now. 1% or 2% higher than they are.
You're saying interest rates in the 90s were a lot higher than today?
Yes. And guess what the stock market returned? 338% in that decade. So we've dealt with higher interest rates, and the markets did perfectly fine.
Well, and I think that's what we're seeing today is the markets are doing fine in this reasonably well in this inflationary environment, because businesses are able to navigate it through raising prices. And now we talk about good business. Now, not all businesses some businesses are hurt by it, maybe more so than others, but some businesses are able to raise prices during inflationary times and able to keep up. But some aren't. But yeah, I agree with you, Brett. It's the 90s we dealt with. In fact, I think inflation during the 90s was more in the 3% range.
Yeah.
During that time, and then interest rates were 3 or so percent, 2 or 3% higher than that. So yeah.
Yeah, the one thing I'd say is the businesses that suffer are the ones that have to continue to borrow to grow, that aren't profitable, that can't fund their own growth, or or maybe they have to borrow a lot of money and they can't figure it out. What you saw in 22, that's what it was. I mean, and there was a panic in the market where everything that wasn't profitable just got hammered. And then you had certain companies realize, hey, we've got to get to profitability. Those companies have come back and done well. The ones that haven't gotten to profitability, it's more expensive to fund their growth and it's not coming. And so that's how short-term stuff, short-term interest rates, the cost of money, it does matter. It's just specific to the company that you're talking about.
Should our clients worry about those headlines? That's ultimately what it's about, right?
No, I mean, I don't think they should worry about it. We should. I think we should worry about it.
Yeah.
But I think our process is set up to deal with these sort of situations, where we're looking for businesses that have, we talked about it, competitive advantages with good management. We talk about that. That's one of the reasons why we invest the way we do, is because we want to be able to withstand difficult economic times like inflationary times.
And I'll say this, should we worry that the inflation number comes out at 3% and so the Feds might only cut once instead of 3 times? No. No, we should no. And should our clients be worried about that? No. Now, is the market going to react in the short term to it? Yeah, it is. It's going to react to it. But if you're making any decisions based on if the Fed's going to cut 3 times or 1 time, then you're worried about the wrong thing. You need to be worried about the business that you own and how they're going to be able to do if they cut 3 times or if they cut once. If you own a business that isn't going to be successful if they don't cut 3 times, you shouldn't be owning that business in the first place. I mean, that's what it comes down to. So if they cut once, if they cut 3 times, like if that's what we're worried about, yeah, we shouldn't even be invested in that business. And the only people that are worried about that are people that are trying to time the market. I mean, that are short term trying to trade around to make a buck in a week or in a month. And candidly, it's a fool's errand. So I think the people that are really worried about it are fools.
Well said, Spencer. I think because of our process, I could care less about interest rates or Fed decisions, because I know the businesses that we own in long term, we're going to be totally fine. I could, from a trading opportunity, trading options, it's fun and it helps with opportunities, but zero worry, and our clients should have zero worry as well.
So I saw this quote the other day and I liked it so much that I wrote it down. And it's something that I think applies to our philosophy, investment philosophy. And I don't even know who said it, but it said the investment variable we aim for is endurance. And I mean, that's what we're looking for, is we're looking for companies that have endurance, that can endure. And that means all kinds of economic environments. And another way, the way that we typically have said it, is durable. I think there's some similarities there: durable, competitive advantages, or endurance. And if we're investing, if you're investing like that, then definitely the short term has less meaning, and you're really looking down the road and say, okay, are these earnings durable? Are these is there endurance built in this business? That's what we're looking for. And
Yep.
You shouldn't really have to focus on the near term or the short term.
So with inflation and interest rates is the question. I think where it does matter is the next subject, which is in an election year, right? Because that's what the media is pushing out for one candidate, saying it's terrible, for the other candidate saying it's great, right? So an election year, what I'm seeing is the notion that we've moved too far too fast. We're up, NASDAQ up over 40% the last 12 months. The market's got to come. It's got to fall, right? It's too expensive right now. Don't buy, because the market's going to fall, especially in an election year. Short-term thinking, should you hold off on doing anything until the election's over, versus long-term thinking? What should clients do? if you have $1 million, should you wait for the election to be over for the dust to settle? Or should you just not care about that? What do you think?
I think it's the
What's
same.
the year going to be like too within an election year? I mean, tell me about that.
I think the answer is exactly the same that Spencer said when it regarding whether or not there's going to be 2 cuts. If you're investing based on the Fed's decision whether there's going to be 2 or 3 cuts, then you're looking at the wrong thing. I think that's the same thing applies to the election this fall. So I think you're focusing on the wrong thing. You need to focus. We need to focus on owning durable businesses, great businesses. I mean, that's what I'm focused on. I'm not focused. And I had this conversation with a client the other day. He asked me the same question, you know, how's the election going to affect? And I'm not saying that won't affect it. You know, in fact, we had corporate tax cuts a few years ago, and that had a real impact on the bottom line of businesses. That increased the intrinsic value of businesses by that corporate tax cut. So yes, there is a short-term impact, but long-term, you should be focusing on owning, you know, what kind of businesses you own. Are they good businesses? Is there durability or endurance in those businesses? That's what you should be focused on.
But wait, this is the most important election, Brian, in the history of the country.
So they always say that.
A dude with a
Hold
great
on, are you talking about Bountiful City Council or presidential election? What are you talking, which one?
Don't get me started on the land bountiful. We got some issues there.
You,
But I'm talking
hey,
about presidential election.
I know
The most
you
important.
are.
In fact, you know what, Spencer?
Yeah.
This is supposed to be the craziest, most intense, most corrupt, most
All of it. All of it.
I mean, there's going
All
to
of it.
be, what do they say in Ghostbusters? Rain and fire, dogs living with cats. I forget the exact phrase.
Yeah.
It's going to be that.
Here's the thing. My perspective on your question is I do care about it from the standpoint of if I have $1 million, I'm not going to put it all in the market today. I'd follow our process. I'd go buy the assets or the companies that are undervalued, and I'd wait for the market to give me an opportunity to buy the other ones. And
You wouldn't wait for a certain candidate to become president.
no, I'm not. I'm not going to, because here's the thing. If Trump wins, if Biden wins, no one knows. I mean, the polls are so close. No one has any idea what's going to happen. And it might be someone else. I have no idea. But at the end of the day, that company is going to have to deal with either one. And there will be trends. There will be short-term trends associated with it. But we're looking long-term. And whatever those CEOs, the companies that we're invested in are going to have navigated Trump before. They've navigated Obama. They've navigated Clinton. They've navigated Bush. They've navigated all of them, and they continue to find a way. So I'm not worried about who's going to win the election from owning specific companies standpoint. I am from a planning standpoint because taxes matter, and obviously the Trump tax cuts are going to horizon in during the next term, and there's those types of things. But that's more aware from a planning standpoint. From an investing standpoint, go buy good companies at the right price. And if it's not the right price, okay, we'll just patiently wait till the right price comes because someone's going to panic at some point.
You jokers are giving me the same answer for 2 questions.
Sorry.
I mean,
We're so
come on.
boring. Brian, you're so boring. Come on.
So,
You need to be a little more
but
flashy.
don't you think it's going to be a messy election, though? I mean,
I'm sure it will be. I'm sure it will be. I'm sure it'll get ugly. There will be accusations, and whoever wins, the other side's going to say they didn't win, and it just gets uglier and uglier. That's what it seems to do. But guess what? America continues to find a way to push through it, grow through it, and hopefully the next government, whoever it is, can get a few things figured out when it comes to the issues that the country's dealing with. And
all right.
I'm a little pessimistic at times, but overall, I'm still optimistic on America and what we have going on, and specifically the private sector in America continue to innovate and grow and do good things.
Yeah.
Think about that. That was kind of my point. Is, I mean, there's all kinds of problems we have in America and our political system, and I mean, we got plenty of problems, and there's a lot of things that we can definitely do better. But despite that, there's think of the innovation that's going on in the world right now. It's incredible. I mean,
We're
there's
gonna get to that innovation here in a second.
yeah, but that's my point is,
So,
despite all the problems, there's all kinds of incredible things happening.
so from the perspective of a listener, what you're saying is participate in American, in the republic that is America by voting, but don't worry about your investments as it pertains to who wins or how messy it is.
I wouldn't, and I'm invested the exact same way as my clients, our clients. We're all invested in the exact same businesses. And from an investment perspective, no, I don't worry about that.
That shouldn't be your focus. I mean, the focus should be on what businesses do you own, and are they good businesses? And it shouldn't be your investment approach shouldn't be impacted or shouldn't be steered by who's going to win the election.
Who's going to be the next Department of Homeland Security person?
Right. Yeah.
All right. Okay. What I'm hearing is everyone just needs to relax. That's what I'm hearing. All right. Talk about innovation. Brian, there's an AI boom happening. Boom! It's happening. What is Irongate doing to participate in this AI boom? Because you're not owning, my favorite stock, AI. Is that even a stock? I don't know. But what are we doing to participate in the AI boom?
Yeah, that's a good question. I mean, we do have some businesses that are very heavily and have been investing in AI for a long time. For example, Google has been at the forefront of AI and AI research and investment. Microsoft, Amazon, Meta as well. I mean, so we have significant investment in AI. I think most people, when they think of AI, they think of NVIDIA, but there's all kinds of other companies that are heavily invested and have been investing in AI.
So it's an AI boom. I mean, the semiconductors index is up like 70% compared to the S&P up 20, right? So it's boom. If somebody hasn't participated in that boom, is it too late? Have they missed it? Because here's the thing, you hear two things in the market. You hear it's too high, it's too expensive in a bull market, or in a bear market, you hear it's not low enough, it's going to get cheaper. So we're talking about the bull market side. It's too expensive, it's gone up too far, too fast. Is that the case?
I mean, I think I think in some cases, there's a lot of speculation going on in AI, and there's some crazy valuations that just don't make any sense. I listened to a podcast last week, just talking about the valuations in AI. Now, I know when most people think AI, you're thinking NVIDIA, but it's beyond. There's hundreds of businesses out there that are trying to come up with the next AI product, large language model, and valuations in that sector, which is mostly venture capital. Valuations are crazy according to these experts. So, but I don't, it's hard to say. You can go back to when the Wright brothers invented flying, and everybody was trying to get in on that, and all these airlines, and if you would have invested in airlines over the last 100 years, you wouldn't have made any money. So it's hard to it's difficult to say how this will play out and where people are going to make money in AI. I think AI is going to change our industry and change so many different industries, and I think every industry and it will be impacted. But how does it play out as an investment? It's still we don't know, and time will tell.
Tell me a trend, a theme, a boom type that we're talking about where there weren't players that made money, and there weren't a lot of people that lost money. I mean, you can go EV over the last, 5-10 years. People who bought Rivian at the open, I mean, at the IPO. Now, time will tell. Who knows? 20 years from now, who knows? But they're down a huge percentage. People that bought Tesla at the open are up huge. So I think it's owning the right businesses and the trend. I mean, even we'll go crazy, go cryptocurrency. I mean, in the boom in 2021, some people did well, other people did. So it's owning the right names in that trend, because there will be some winners and there will be a lot of losers. That's just candidly what it'll happen.
There will be a lot of losers and, like you said, some winners.
Yep,
You
exactly.
go back to the dot-com era. There were so many businesses that failed and went to zero. And then there were a few like Amazon that made it big. But Amazon was like probably one out of 1,000, maybe more, 10,000.
Yeah, and I think that's a good way to say it. There will be some winners in the AI space, and then there will be a lot of losers. So you got to make sure that you're allocated towards the sum. And that's our job as advisors, to try to find those companies that you'll do well in.
And I think the companies that we are invested in are pretty low risk companies that are participating in AI. In the case of Amazon, Microsoft, Google, Meta, I mean, they're all heavily invested in AI and currently investing heavily there. So that's a pretty low risk way to approach it. But we're keeping our eye on it, and who knows? We'll see what happens.
So we have been participating in the AI boom. That's why our portfolios have done so well, in large part. But also we're keeping our eye on some businesses as well. Brian, is it safe to say that we do not own, that we would own if the price was right?
Yeah, for sure. I mean, NVIDIA, and not that we're not recommending any business. I've mentioned a few companies. This is not a recommendation to go out and buy those.
Yeah.
But yeah, there's various businesses that we like. The price looks, not sure about the right, what's the right price. That's probably the big debate, but that we have. And but yeah, we continue to watch it. And I think AI is going to have a big impact on hundreds of industries and businesses and thousands of businesses, and it's going to be big. I'm pretty sure.
It already is. It's gonna get. So, all right. So we are keeping our eye on that. And again, what I'm gonna say is it's kind of the same answer as the other two questions. Long-term thinking, right? It's buying the best business that meets our criteria at the best price. Yep. Man, we sound like broken records. All right, so let's change this up a little bit. Spencer.
Okay.
March Madness is over. How good did UConn look?
Pretty good. Pretty good.
I think they trailed for like 4 minutes all tournament, something like that.
Yeah, they're good. But
I'm frustrated, Spencer.
Okay.
I'm not worried about the election whatsoever. What I'm worried about is the sanctity of college athletics. You've got the NIL out there that's screwing everything up. Short-term thinking, it's screwing everything up. I need long-term thinking here, Spencer. I'm a frustrated college athletics fan. I'm going baseball, football, and maybe even basketball. Talk to me, brother.
So your preface is just wrong in the first place.
Wait, what? How?
You said the sanctity of college athletics. The sanctity of college athletics, really what you're talking about is the amateurism of college athletics. That ended a couple of years ago. The sanctity of college athletics is completely gone. It's gone.
Well, it was never that.
Some of it
Let's
back?
face it, it was never there.
I argue, Brian. I argue it was. There were
Was it?
There were schools that were paying guys and that were cheating, but as a whole, I do believe the sanctity. Absolutely. What, did I not receive a dime? Did anyone, I mean, there was 95% of the schools, you had some schools cheating for sure that were paying guys, but a large majority, the sanctity or the amateurism of college athletics was
Gone.
absolutely there. And it's no longer there.
Okay. Okay.
It's
So
what we're talking about is professional sports attached to a university.
yeah,
That's
here's
what
what
we're
I'm
talking
talking
about.
about. I'm talking about some of my favorite players that I like to follow on my favorite college teams, playing there a year and then getting a pay to go somewhere else, and they're jumping around.
Yeah,
It's
it's
like,
not
what
amateur
is this
athletics.
mess?
It's professional sports. And here's the great thing
So what's
about it.
going to happen?
We had a wise client, Danny Ashworth, who, oh, I probably shouldn't have said his name. You may need to edit that out. We had a wise client who said, anytime you have a relationship and money enters that relationship, it changes it. Doesn't necessarily make it good or bad or right or wrong or anything, but it changes it. If you go into business with your brother, all of a sudden there's a little bit of a different dynamic
Yeah.
because money has been introduced into that relationship. Same thing with sports and college athletics. Money has now been introduced, and so it is a different relationship between athletes and the school, and then fans and the athletes. It's just different. And so what ends up happening? I mean, it's what Chip Kelly said, the only model that's going to work. And here's the thing. This is where I am going to say something. The individuals who are so they have been delusional to think that they are looking out for the better well-being of NCAA athletes by saying they need to get paid. Now, they are saying they have looked out for the top performers of NCAA athletes to get their market value. But unfortunately, in doing so, what will happen is there will be a super league and there will be 64 teams or 80 teams or whatever of professional sports attached to it. And anyone who's not in that, budgets will have to be cut, compensation. It's just going to change the model. And ultimately what happens is sports get cuts. So men's diving team at a university, goodbye. Girls track, whatever it is, tennis, whatever it is, the non-revenue generating sports, ultimately scholarships will not be there for a bunch of athletes at a bunch of lower end schools. So as a whole, less kids will get their education paid for and have the opportunity to do that and to compete at that level. So for sure, the top performers, it's much better for them. They're going to get a value attached instead of that money going to the NCAA or something like that. So, the quarterback at Utah or whatever. Can you imagine whatever he made this year?
So, but
Rising?
here's the thing. Here's the thing, though.
Yeah.
I have a buddy who paid I won't name names. He paid $250,000 to pull a player from one school to another,
Great
and he
job.
wasn't even that good. He didn't even do that good, and
Oh,
he didn't
yeah.
even show up for my buddy to do anything to help his business. Like, do you think it's going to keep up at the trajectory that it is? Or do you think it's
No.
going to slow down? Because that's a terrible return on your
Yeah,
investment.
no, the market will figure itself out. We're in the wild west of it right now, but for those top schools, it'll be big money. It'll be good money. It'll be good money at those top schools. Whatever, because the TV contracts associated with this Super League will be good. And there's a built-in fan base because of the alumni. And so it'll work, the model will work, but it's pro sports. They'll just be competing with the NBA and everything else. But and the I mean the soccer teams at Idaho State University or Weber or even a Utah State, the non-revenue generating sports are going to struggle and they'll ultimately get cut. Stanford a couple years ago cut like 16 sports. The Olympic sports and different things like that, they're going to get cut, and athletes. I know I'm sentimental because I experienced one model and I loved it and I grew up with that model. And so this new model, I don't love it, but other people who didn't grow up like we did in our generation and stuff, they won't know anything different, and it'll just be the way it is.
So from a college football fan, I'm going to summarize this, right? And college baseball and college basketball. Short-term thinking, gosh, I don't like this. Long-term thinking, gosh, I don't like this.
I'm with you 100%.
You didn't help me one bit. You helped me with inflation and with the election and all these other things. You didn't help me with college athletics.
Pro sports, man. It's pro sports. That's all it is. That's all it is now. It's pro sports. And it's unfortunate because I loved the model of college athletics. And was the NCAA perfect? No. I mean, disaster in so many ways. And you can be critical all you want, but I will forever be grateful for the platform and the education and the opportunity that the NCAA provided me. I didn't get paid a cent, and I don't feel like they owe me anything.
Well, if I was a booster at Utah State during the day,
would have given me $7.
I would have bought you a little
cheeseburger,
piece of pizza or something.
Thank you. I appreciate that. That would have been nice. But
you know what the NCAA, as we wrap this up, you know what the NCAA reminds me of?
What's that?
The Fed. They're just a bunch of idiots, all of them. You know,
bless their hearts.
You got the most educated 400 PhDs, the NCAA. You have all these smart academics, and they're all dumb.
Yeah, they can't figure it out, unfortunately. So
with that,
I think Brian's just sat here and been like, I'm not going to say anything. I'm not going to tick anyone off at the NCAA. I'm going to keep my mouth.
I don't want to have the NCAA audit our business. Yeah. Well, we were 3 for 4 today. That fourth one. Hey, that's all right. So, folks, I guess to tie all this up, there's short-term thinking. There's how we're all hardwired, which is, days to weeks, as we talked about at the very beginning. But the focus needs to be more long-term. Don't worry about the headlines. Don't worry about the election on your investments. We've got you covered in that way. Don't worry about interest rates and inflation. We've got you covered that way. College athletics, I cannot help you. So with that said, thanks for joining us today. Until next time, bye now.